Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Adam Whitlam, part of our Canadian dollar institutional sales desk in Toronto. This week's episode is titled, The Rich Get Richer. I'm Ben Reitzes, and you're listening to Views from the North. Each episode I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Hi, Adam. Welcome back.
Hey, Ben. How you doing?
I'm all right. It's summer, so summer's always good.
I know. I'm kind of wondering what I'm doing here and why I'm not on a golf course.
You've already had a nice summer, so
That's
we should be
true.
asking that about me. But we both have very nice tans, so I'm very happy with summer so far. It is summer markets, so things are most definitely quieter than usual, and why I've recorded fewer podcasts than usual. But there's still some stuff going on, and the events over the past couple weeks have been interesting, let's say. Between Canadian jobs coming in pretty terribly, US CPI coming in, it was hot, but not as hot as feared. So the market really loved it. I find that we can talk about that a little bit. The diverging views on inflation between the bank and the Fed, or just maybe, I guess, the way they look at it more than views per se, is notable. And the firing of the BLS chief is, we can go a little bit there as well. And then last but not least, and maybe we'll start here, provincial spreads and risk in general. Provi spreads have been very resilient through all this. As risk has, amazingly. Stocks seem to only go higher, and spreads have generally held in pretty well. We've backed off the tights, which I think is notable given that stocks are at a new high. Is that, I guess, what is that a function of? Do you have any concern that maybe credit spreads not hitting new tights when stocks are at new highs? Is that a red flag for you, or?
Well, there's also some notable divergence between corporate credit spreads and high yield credit spreads and Provi spreads. So, as of late, like if you look at high yield spreads, we're kind of back on index basis below 300 basis points. So that's getting pretty tight there. Corporate spreads are getting very close to their tights. So really, Provis have underperformed a little bit.
Okay.
It's twofold. Part of that is a little bit of summer markets, less liquidity.
Weird when the highest quality is what underperforms.
Right. And I think another part of that is just outright spread levels compared to where they've been sort of earlier in the year. Also, there's been a bias in the market from a lot of investors for when's the next blow up. We had Liberation Day. That was very short-lived in terms of, a credit event or a risk event. And there's been some concern about what's going to happen next if we start getting weaker jobs prints. When's the economy going to turn over? You're getting a lot of headline risk about housing markets, both in Canada and in the US. So there have been, I think, a lot of accounts that were underinvested in riskier credit that at this point are throwing in the towel. It just hasn't, that thesis hasn't panned out.
Let's chase it. What could go wrong?
Exactly. So no, does that mean it's the last gasp before a big blow up? I don't know. I probably can't call that at this point, but certainly I think from a carry perspective, bleeding away that carry, given the spread differential between Provis and corporate credit, is painful. So I think some of that's being unwound, which is why corporate credit continues to outperform here, why Provi credit's lagging a little bit. We've also seen in the new issue market. Look at this week. This week on a summer Monday, we had over $4 billion in IG corporate supply in Canada alone, and it was absorbed no problem. So,
well, on the corporate side, on the Canada side, less so, I would think.
Oh yeah, on the corporate side, that's what. There was duration coming in. Yeah, on the corporate spread side, it was easily absorbed, oversubscribed to the max. Certainly, you can see in the Canada curve, and I would even say in the Provi curve, there was stuff coming out against it. It's not like there was new money being put to work, but clearly there's a little bit more of a reach for riskier credits.
Well, I guess this just keeps going until we hit a speed bump. I don't know what that is. Maybe weaker data, but it's so some somehow the weaker data that we've seen thus far hasn't really impacted markets materially. I mean, I'm at a bit of a loss as to what drives it, unless you get some real systemic problem, which you obviously never know about until it happens, or usually don't know about until it happens. So we sit here and wait, and we grind and grind and grind.
One thing I'd say is also a little notable is I'd say, and this hasn't been the case here. We've had our new issue provincial books kind of across the board have been building fairly easily, have been all fairly well filled. But the sense I've had over the summer mainly, I would say, is, and some of the comments I've heard, is that bonds have been more available across the street in terms of new issuance. I think that's also, we've had a lot more potential issuance windows from some of the provinces where they've been a little long to actually come to market. And I think part of that is some of these books are building a little bit slower. Now, is that vacations? Is that summer liquidity? Or is that outright spread levels? And I think what we're seeing and why we're kind of off those tights is that maybe it is outright spread levels.
All right. But there are some parts of the curve that are attractive, though, yeah? So we've seen consistent picking away in kind of the 20-year sector, and it looks pretty cheap, I think. What metrics would you look at to assess that?
Yeah, I've looked at your 10s, 10-year, 20-year, 30-year fly, compare that against your 5-year, 10-year, 30-year fly. And even a little bit shorter on the curve. And kind of what you'll notice is that 10s have really performed quite well. So it's actually helping 20s to stand out quite cheap. Now, I get why. There was a big buy in the market in general of sort of 3-year to 7-year provincial assets. Some of your best asset swap roll down was there. HQLA books were actively adding to that. But that in turn rallied 10-year provincial spreads. And in the meantime, the 20-year sector just sort of stayed in the same place. Now, we also had a pretty decent move in 20-year off-the-run Canada bonds, which also, if you look at it on a spread basis, is one of the reasons that provincials look so cheap at this point, is the provinces didn't really react to the same extent that we saw in some of the 20-year off-the-run Canadas. But certainly that 10s, 20s, 30s credit fly is really starting to stand out. Ontario 45s, Ontario 43s, even Ontario 41s, all of that sector. And we've seen, astute clients buying that.
Okay. So even though spreads are tighter, there are still some opportunities.
Yes.
All right. Well, that's always good to hear. Back to what could blow things up, I guess. I mean, I guess we can go to the U.S. We had the weak jobs report in the U.S. CPI came out, and if you were to just take it on its own, abstract of the rest of the world, if you were locked in a room and didn't know what was going on and you saw that CPI print, you would say, hey, that doesn't look like great news. Inflation's pretty strong here. It's at 3% on the core, and up 0.3 months over month is not great. Yet the market seemed to really cheer it on. I know that the expectations were for a higher number, like the whisper was higher than the consensus. And so fears were there. So that's what drove that initial knee-jerk reaction to rally rates right across the curve. But that faded through the course of the day to some extent. The front end kind of held its bid. And it seems as though despite inflation being still pretty strong, the Fed seems pretty keen on easing. I guess Fed rate cuts solve everything. Like, are we going down a road where the Fed cuts when inflation's still pretty strong? And I mean, who knows what happens with the data with the new head of the BLS? Everything just kind of seems like we are headed toward a very different world than I guess what we've lived in for the past 20 years. And those changes don't seem to be great for the U.S.
Doesn't it seem absolutely backwards to you? Like, it kind of seems to me like Powell is sitting in these meetings and these conversations are happening, and he's like, have we all lost our minds?
Yes.
Like, we are not a politicized institution. We are supposed to be independent. We all know that the president has a bias. There's no question. He's very clear about that. But to your point, when you're looking at Supercore going up to 0.5, which is the highest it printed in all of 2025, and clearly that means that, inflation is leaking into the services sector in a decent way. I mean, the expectation for that number was that it was going to be higher, but it's because tariffs were going to push up goods inflation. Goods inflation was no higher at all.
Yep.
So that's a bigger problem for an inflation targeting central bank.
One would think that services inflation it is driven by domestic activity. And so if you're cutting rates, you're juicing domestic activity. So then you're only pushing that inflation even higher while you still have this unknown of tariffs impact on goods prices. So, I don't understand. I mean, I guess we've grown up in the same era. Inflation has been relatively easy to hit at 2% for, I mean, all of the post-crisis financial crisis era until the pandemic. So I mean, arguably these things haven't really been an issue because it's just been easy with global disinflationary pressures. But when policy is harder, this is, I guess, what happens. You get political pressure, you get greater uncertainty on the outlook. And there are other cross currents on inflation and on the global economy that we just didn't have to deal with in the past. And that makes things a lot harder. And so, yeah, maybe Powell is like, you know what? Where are we? What are we doing? I mean, that's kind of what I would say.
Do you move? So here's a question. And maybe this, like you said, inflation's been fairly easy to manage at 2% for a number of years. But, we have certain moments in history where there's like massive technological development. And so I think, most people can agree that AI is that for the current iteration. It was the internet. That was probably the last one, was the next, major growth phase. And so in this next major growth phase, could it be that now you have to move the goalposts? Inflation actually is, maybe neutral inflation isn't 2. Maybe it actually is 3.
Let me stop you there before you keep going. Economic theory would dictate things like the internet and like AI make people more productive. Higher productivity equals lower inflation at the end of the day. So these are disinflationary technological advances generally. The concern is more that like you have central bankers willing to accommodate inflation. You have most global governments, I would say, running pretty large deficits especially compared to the past 15 years. I mean, the U.S. is by not the worst, but the worst among Western countries. And the sustainability there, like it is not sustainable. There is a point at which it breaks. I don't know where that is. It might be next year. It might be in 100 years. I don't really know. But it is not sustainable at 7% of GDP or 8% of GDP.
Unless you're running 7% inflation.
Well, that's it. So that's where that's where you end up to some extent. Is that where we're going? And if that's where we're going, I mean that seems like a much more challenging world. I don't know what that means for Canada. I think it leaves Canada in a very difficult spot. That like maybe all of that chatter around Canada trying to diversify its trade, which is something that would be great. But I don't really know how that's actually possible. You have a behemoth below you that is the largest consumer in the world. I don't know how you get away from them when you don't really have growth in Europe and you don't, and China is not a country you can access, and like where are you going to get growth from? I don't know. But for Canada, if you have a U.S. where inflation is the new norm, and some of that does spill over here, does that mean we have to run tighter policy, or maybe the currency strengthens more? I don't really know. But it does open up a lot of difficult questions, I think, on the macro side, that just a period of global transition and the stability that we've seen it's really since like 2000-ish, but even into the mid-90s, there was some extent. I mean, there's a little bit more going on then, but 30-ish years of stability, maybe that's over. And we're in for a wilder ride for the final, 10 to 20 years of our careers. Does that make any sense?
Yeah. I mean, it's similar to kind of your point. It's a little bewildering globally, central banks' willingness to run hotter inflation. I'm sure
Is it global? So hold on. Is it global? So the Bank of Canada is not willing. Arguably,
they're not hiking rates.
They're not hiking rates. So, but they just don't know. And I think when you don't know and you have a weak economy, you're going to be reluctant to crush your economy. And I would say the same thing about Europe and the same thing about the UK, where inflation is higher than they'd like for sure, but their economies aren't in good shape. And so when you have that combination, you're in a tough spot. Mm-hmm. And you don't know that the normal monetary policy rules, the normal relationship between an output gap and inflation are going to hold. What do you do? Like, how do you manage that? And so I think their reluctance to ease aggressively has been notable. And that's what we've seen from the Fed until now, but it's until now. And cuts are coming. And maybe like it makes sense that the Fed's cutting to some extent because you do have that weaker job market. You do have like the growth backdrop has softened, but the inflation issues are clearly there and maybe stronger there than elsewhere, arguably, just given the resilience in the economy. But it's a tough backdrop. At least it makes for interesting markets. Yeah. That I will say.
Yes.
Which is certainly positive. What's the biggest market theme you've seen over the past? Well, I mean, you've been on vacation a fair amount this summer, but let's go over the past couple of weeks.
Canada underperformance has been one of the most topical themes. We've had a couple of false starts. We've had, I think the jobs report,
Canadian jobs
report certainly brought in a couple of longs into Canada who ended up being kind of poorly positioned relative to the US. And then we saw kind of another wave of yet stop outs in Canada relative. And that's kind of pushed some of the underperformance we've seen in our market. The interesting part is there's been a bit of a divergence on what's happening in futures and what's happening in cash. On the cash space, we are seeing investors who are kind of wading into the market, whereas some of the recent sell-offs or underperformance that we've seen has been dictated by futures. That being said, if you look at some of the blocks, like out of the last, I think it was XQ, out of the last 10 XQ blocks that we've had since June, 9 of them have been buys. So I think you do have positioning still setting up from, on the larger side in cash, long Canada, but the regular futures algo flow keeps cheapening up our market. So there's going to be some limit, I think, to where that can go. We're getting into, I think September has a decent index extension for Canada. Yep. So coming out of the summer should be kind of favorable. Now that'll be met with some of the issuance taps are going to turn back on as well. Provinces are doing fairly well. Right now, we're sitting around 45% funded kind of across the board. For the provincial landscape, we had Ontario do their Q1s, which were bang on kind of what the budget expectations were. I'd say generally fiscal pictures that were presented early in the year for these provinces haven't deteriorated any further. So, from a borrowing perspective, we're ahead of pace.
I'd actually bet they're a little bit better. Like a number of provinces put in some contingencies.
Yeah, I'd agree with that.
I'd guess we're probably slightly better. Like nominal growth is going to be pretty crappy in Q2, but we'll see how things rebound in Q3. But I'd just guess, given the resilience on the consumer side, that they're probably a bit ahead on tax receipts. But that's just me guessing.
And you had some other ones like Alberta where they recently reported their final fiscal 24 numbers and their surplus was considerable. I think it was 8 billion versus what they had originally posted was, I think, 500 million. So you have some that are, it's a large improvement. So, maybe that September borrowing calendar will underwhelm given that they're so far ahead of schedule. And I get why. Threats of tariffs, they wanted to get as much done as they possibly could. So that maybe combined with the September index extension could help put a little bit of a bid into our market. I think the front end in particular still is maybe on the cheaper side. It's not as cheap as it could have been. It was great when twos were at 280 and,
Well, I'd say how much do you want markets to price in? Like we're already pricing a little more than one cut. Like, should we fully price in 2, which kind of introduces the odds of 3? I'm a little skeptical there at the moment, personally. I think 1 to 2 cuts is fine. After that, there's just not that much value for now. Things need to look worse for the front to price more, and I do think the data are going to kind of push in that direction to some extent later this year for sure on the inflation side. But the bank's minutes, they're split. Half of them think they've cut enough. The other half say, well, if things soften on the inflation front and the economic data stay soft, then we can probably cut a bit more. That doesn't scream like a central bank that's itching to cut another 75 or 100 basis points. It sounds like they're just like a 1, 2, maybe it is 3, maybe 75 beeps is like the max there. It doesn't sound like they want to be aggressive on cuts. So,
well, if you don't like those, if you don't like 2s at 265, I can't imagine you love 5s at 290.
No, 5's not great either. I mean, that's going to depend on treasury flows as much as anything else, and mortgage refinancing through the back half of the year, which will be interesting. I guess it depends on consumer behavior there, and I don't know how to predict that. But lots of 5-year mortgages from 2020 coming up, and many people like to chat to me about that. So I know there's lots of them.
So what's interesting, on that perspective. So, there was a little time period there where we actually did start to see some stuff happening in the 5-year space from the bank trader community, but that's kind of stopped. So now we're actually seeing a little bit of the opposite where they're back to the regularly scheduled flattening that we had at the beginning of the year. And that flattening resulted from resets into threes, resets into shorter duration mortgages. So it'll be interesting to see if we have that happen again, if we see more resets into variable, and if we see more flattening interest from these guys. That's exactly the type of resets we're going to see in the mortgage community.
So I think what happened is mortgage rates went below 4% in the 5-year, and then you saw people coming in and doing them, and now they're back above 4%.
Right.
And as much as it's not like no one's banging on the table, I think most people think more rate cuts are probably coming. And so they're happy to kind of sit on the sidelines in a variable for now, or in a shorter term and be like, okay, I'll wait and maybe I can get something a little bit cheaper. And the 3-year is anywhere from 20 to 40 basis points cheaper. So you are sub 4% there more likely than not. So people like the cheaper option. I don't blame them. I would do the same thing.
4 is the magic number.
I think 4 is the magic number, which is interesting. Maybe that'll be the title of another podcast one day. How about a little bit further out the curve? That front end dominated by the bank and bank treasuries and 5s. How about 10s and longs?
So, I mean, 10s and longs on an outright basis, I think would be pretty challenging at this point to really like. I mean, I'm still in favor of steeper curves. I do think, similar to my view in 5s and in the front end, Canada, there's a limit to how much cheaper we can really get versus the US. I've always earmarked 75 basis points as kind of the benchmark level of where we trade through the US. And we're not that far away in 10s at this point. Now, Canada has a history of
blowing right through whatever you think is normal.
Whatever the target is, just tack on 20 basis points and that's where it's headed. So maybe that goes to minus 50. But if that type of environment was to show up, then I think, I would want to be interested in buying Canada.
Yep, I'm with you. I think that might be the trade for later this year. When we get the Fed continuing to ease, and you're going to probably have Canada continue to drift weaker. And the question is when to go the other way. So something to definitely keep on the radar through the latter part of this year. I think that's good enough for today. Unless you got a favorite trade idea for the folks out there. It's summertime, but. You never know.
So there's a couple of things happening. I sort of like some of the pension credits at this point. So pension credits, especially some of the backdated pension credits, like we know what the issuance profile looks like for current, but if you look at some of the off the run pension stuff at this point, we're getting back to levels where CPP is a great example. CPP is sort of trading at like a +1 to +1.5 area for some of the backdates, just short of 10-year. I think that's actually some decent pickup. And if you, in particular, you look at like 2031 to 2034, that's where you get your best pickup. You go back into the 5-year sector, it starts getting tighter again. So from a historic perspective, to kind of give some guidelines, the last time you could get a CPP credit at +1.5 versus Ontario would have been sort of summer 2024. So it's been a while. So I think there's some value there. I think also, some of those borrowing programs similar to the provincial programs were front end loaded. So there really isn't a lot of supply left in that stuff. And then conversely, if you're talking about these quasi-government credits, if you look at like dollar SSA market, dollar SSA G spreads are trading at unbelievable tights.
Well, that's treasuries.
That's treasury. That's
the other side of that.
But the thing is, we know that the SSA issuers have a defined issuance profile. So like they will be back in the market when summer is over. So a G spread at 4 back for an SSA credit is just very, very tight relative. So I think on a comparative level, I think some of these pension credits, when we're talking about +1.5 versus Ontario's, is a pretty good place to get involved.
Okay. I agree that when I saw that they were 1.5, I was like, oh, okay.
Yeah.
I think that's something that gets some attention. Okay, cool. Thanks, Adam. Hope you have a nice rest of the summer, and I hope all of our listeners out there enjoy the final few weeks of August. And I'm on vacation next week, and then I'm headed to London in 3 weeks. So I'm not sure when the next episode will be, but I'll try and stick one in that in-between week, or maybe it'll wait until September. But either way, I hope everybody enjoys the summer out there. Thanks again, Adam.
Thanks for having me.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.